Welcome back to the Deep Dive. Today, we are pulling back the curtain on the hidden plumbing of Wall Street.
We really are.
It's this ecosystem that's so vast, so complex, that the actual mechanisms governing trillions of dollars, they often run through infrastructure we never even see.
And it's maintained by companies we rarely, if ever, hear about.
Exactly.
We're talking about the infrastructure that underpins corporate democracy itself. It's absolutely critical, operating right there in plain sight for institutions, but completely invisible to the average investor.
Absolutely. And our deep dive today focuses on one of those companies, Broadridge Financial Solutions, Inc. Ticker is BR on the NYSE.
Right.
It's an S&P 500 company, a fintech giant, headquartered out in Lake Success, New York, that I think most people, even some professional traders, probably couldn't identify in a lineup.
I'd agree with that.
And yet, here's the striking reality, and you have to get your head around this.
Yeah.
They handle the majority of all shareholder voting in the United States.
The majority. They provide the essential communication rails that corporate America just completely relies upon.
I mean, when you look for a definition of an institutional gatekeeper, Broadridge is basically it.
It really is. They are a public corporate services and financial technology company, and our mission today really is to give you a true shortcut to being well-informed about them.
Right.
We need to unpack how this company, which started as just this tiny little unit inside the payroll giant ADP, evolved into this indispensable monolith.
A monolith that not only dominates corporate governance, but is now aggressively moving into frontier technologies like blockchain and artificial intelligence.
And that's the fascinating part.
The journey is incredible because it's a story of regulatory necessity just breeding technological dominance. We really want you, the learner, to understand this core paradox.
The paradox being
how a company that was built on a mandated role as an intermediary is now the one controlling the future of disintermediation.
That's a great way to frame it.
Okay, so let's unpack this entire history. We have to start way back in the days when stock was still, physical paper.
To really understand Broadridge's DNA, you have to go back to 1962. It wasn't founded as Broadridge.
No.
It was founded as the ADP Brokerage Services Group. It was just a small business unit operating inside of automatic data processing, ADP.
And everyone knows ADP, the original payroll and data processing powerhouse.
Exactly. And when you say humble beginnings, you really do
making sure the records were updated.
Exactly. Ensuring that when a trade happened, the correct records were updated and the necessary shareholder communications were generated.
It was a simple, manual, and I'm sure often error-prone utility function.
It was. But this is the crucial point, right? Its future dominance wasn't guaranteed by its 1962 technology.
No, it was guaranteed by something else entirely.
It was guaranteed by sweeping, mandatory regulatory changes that were completely unforeseen at the time.
And that takes us to the 1970s.
This is the aha moment, not just in Broadridge's history, but frankly in the history of modern securities settlement.
A total restructuring of the financial ecosystem.
The whole thing, yeah. It was restructured through U.S. legislation centered on streamlining how securities moved around. It really came down to two key concepts, immobilization and dematerialization.
Okay, so let's spend some time on these two because they are the absolute foundation upon which Broadridge built its multi-billion-dollar empire. So first, immobilization. Previously, if you bought, say, 100 shares of General Motors, you might physically receive this beautiful, ornate paper stock certificate. Immobilization, which was driven by concerns about paper handling costs, security risk, all of that. It mandated that these physical stock certificates and paper securities had to be stored in bulk.
Stored by financial intermediaries, so your banks and brokers.
So the paper itself just started moving.
That's it. It became immobilized, locked away in a central vault, often at the Depository Trust and Clearing Corporation, the DTCC.
A huge move for efficiency.
A crucial move for efficiency, but it created an immediate and permanent layer of separation between the corporation, like GM in your example, and the ultimate beneficial owner.
You, the investor.
You, exactly.
Okay, so that's immobilization. Then you had dematerialization.
Right. So since the physical paper was now locked away and couldn't be used to prove you owned it, the system had to be completely rebuilt.
You needed a new source of truth.
A new source of truth. Ownership and transactions were now recorded exclusively through ledgers, electronic records, chains of transaction data. not by physically possessing a certificate.
The paper was gone.
The paper was gone, but the administrative need to track who owned what and where they were located just exploded.
And this is where that famous, or maybe infamous, concept of holding stock in street name really comes from.
Precisely. If the physical certificate is immobilized at the intermediary level, well, the intermediary, your broker, legally holds the security.
Behind the owner.
You, the investor, are the beneficial owner, but your ownership is recorded in the broker's books. It's held in the street name.
Okay, so let's walk through the practical consequence of this. So if I owned 100 shares of IBM back in 1970, I had the paper certificate.
Right.
IBM knew exactly who I was. They mailed my proxy statement directly to my house. But if I bought those same 100 shares in, say, 1975, after this legislation, my broker holds the legal title and my name is just a line item on their ledger.
And IBM no longer knows who you are.
They have no idea.
None. The system now required an official conduit, a bridge, to span the gap between the company, which needed to communicate with its shareholders and get their votes.
And the millions of individual investors whose ownership was now, scattered across the ledgers of countless brokers and banks.
You've just created a massive, guaranteed, and incredibly complex administrative problem for the entire financial sector.
And someone had to solve it.
Someone had to. Before these laws, banks and brokers managed their own small, in-house proxy departments.
But this new structure was different.
The new indirect ownership structure where shareholders had to vote by proxy through these intermediaries, it made the process incredibly burdensome.
Every single proxy vote, every single annual report.
Every single communication had to be channeled through a regulated third party.
And that necessity created this lucrative, specialized industry built on compliance and scale.
And the ADP Brokerage Services Group was just perfectly positioned to offer the specialized infrastructure needed to manage that whole administrative and regulatory burden.
It was just cheaper for the banks and brokers to outsource this administrative nightmare, right?
Oh, absolutely. Cheaper than building and maintaining the necessary infrastructure themselves, especially since the service was fundamentally identical across all the firms.
So they didn't just compete. They basically exploited a loophole in the regulatory framework that mandated their existence.
That's a good way to put it. By the mid-1990s, well before the spinoff, ADP Brokerage Services Group had achieved a virtually unassailable dominance in the proxy voting and shareholder communications industry.
They controlled the communication bottleneck.
They absolutely did. And the interesting thing is that even after electronic certificates eliminated the need for physical paper altogether, that underlying regulatory structure,
The street name ownership system.
it remained firmly entrenched. The intermediary's role was just baked into the fabric of U.S. corporate law. The system was fundamentally reset, and the intermediary was now indispensable.
So after decades of this quiet, dominant growth under the shelter of ADP, the unit was just too specialized. It was too large to remain a division of a payroll company.
It didn't fit anymore.
No. So in late March 2007, ADP spun out the entirety of its shareholder communications activities.
And created Broadridge Financial Solutions as an independent public company.
A pivotal moment.
Absolutely. The company was immediately established as a market leader with this massive regulatory moat, and now it was free to pursue its own growth strategy. Rich Daley, who had been so instrumental in leading the unit, he became the CEO right at Broadridge's founding.
And the journey from an administrative footnote to an independent, market-defining public company was complete.
It was.
And that transition really leads us into the next phase, taking that regulatory advantage and solidifying it into a true near monopoly position while rapidly expanding their technological reach.
Right, so the years immediately following that 2007 spinoff were all about proving that Broadridge could be a growth story.
Not just a stable utility.
Exactly. They had to transition from being this back-office service to being a dynamic fintech platform.
And they scaled immediately. I mean, by 2010, just 3 years after the spinoff, the company was processing approximately 350 billion shares for its clients.
350 billion. That sheer volume is the most immediate evidence of their status as critical infrastructure.
And they started driving innovation in a space that's, highly regulated, corporate governance.
They did. We often forget that virtual meetings are not a new idea born out of the pandemic.
Not at all.
Broadridge facilitated its first virtual annual meeting for Intel Core way back in 2009.
Which was a revolutionary idea at the time, moving governance from a physical ballroom to a digital platform.
And they drove the adoption of it. By 2016, they were facilitating virtual meetings for 154 companies. That was a 71% increase just from the prior year.
So they weren't just a plumber anymore, they were the architects redesigning the whole corporate boardroom experience.
A great way to put it. Now, we do have to address the persistent critique.
Monopoly question.
Of course. A company that achieves this level of indispensable market control is naturally going to draw scrutiny. The label near monopoly position became central to any discussion about corporate governance.
Especially after the regulatory soul-searching that followed the 2008 financial crisis.
Exactly. And it wasn't just, idle chatter. In 2010, a comprehensive report was submitted to the House Committee on Financial Services.
And it specifically highlighted Broadridge's near-monopoly position in handling proxy voting.
It did. The question that came up over and over was, if the system is so dominated by one player, does that concentration create risks?
Risks for competition, for accuracy, for fairness in corporate voting.
All of the above. And despite this political scrutiny, the practical reality was that the market just remained unchanged. By 2013, Broadridge had retained its predominant position in the proxy processing market.
The regulatory moat was just too deep.
It was. The barrier to entry, think about it, building the necessary compliant infrastructure and gaining the trust of 1,000 brokers, it was just too high for any challenger to overcome.
And to give you a sense of their sheer operational scale, by 2018, Broadridge sent a letter to the SEC. In it, they stated that its communications reached 140 million investor accounts.
140 million. Think about that. Almost every single person with an investment account, whether it's retail or institutional, is likely seeing a piece of communication that was facilitated by Broadridge.
And they leveraged this dominance through a really strategic acquisition program.
Very strategic. Between 2007 and 2018, they executed over 30 acquisitions.
And analysts loved them. They always called them successful tuck-in acquisitions.
They weren't speculative ventures. They were very targeted purchases to acquire intellectual property or specific client segments or crucial market data.
Let's look at a few specific purchases from 2016 that really show this precision.
Okay.
They acquired Spence Johnson. And this wasn't about processing votes. This was about institutional financial flow data intelligence.
Which is key, because it moves them from simply tracking what was communicated to understanding where institutional money was moving.
It adds market intelligence to their service portfolio.
But the single most staggering acquisition, just in terms of reinforcing their central gatekeeper status, was the purchase of the North America Customer Communications Unit.
The NACC unit of DST systems.
Right, in 2016. This deal gave Broadridge the addressing information, the actual contact data, for about 75% of all public company shareholders in the U.S. and Canada.
75%. Let that sink in.
It's incredible.
That single data point is the real answer to why they are indispensable. If you control the verified, compliant contact details and the communication logistics for 3/4 of all North American shareholders,
you are the de facto communication gatekeeper.
You're it. They didn't just handle the vote. They controlled the ability to even contact the voter.
And they also bought M&O systems that year, further consolidating some of the smaller tech firms that might have posed a localized competitive threat.
And this deep-seated control allowed Broadridge to execute a major shift in their strategy.
Right. They began moving horizontally, expanding from being the proxy communications utility into providing full, comprehensive platform services for the high-value wealth management sector.
This expansion culminated in a huge deal in 2018.
The UBS deal.
Where UBS Group AG's Wealth Management Americas unit became the first major client to adopt Broadridge's new comprehensive software platform.
And this was a clear signal that they were moving far beyond their historical back-office role.
Because this platform wasn't just about mailings.
No, not at all. It covered the entire scope of wealth management operations. It integrated front and back office tasks.
So we're talking about critical, high-volume functions like opening client accounts efficiently.
And handling trade routing, order management systems, asset servicing. They were now embedding their technology into the daily workflow and the client relationships of one of the world's largest wealth managers.
Which required massive internal scaling to support.
It did. By 2017, the company reported having 10,000 employees. The story really changes here. They are no longer just an administrative spinoff.
No, they're a sophisticated, complex, full-scale fintech provider, and they are essential to how the market operates.
And that technological muscle really sets the stage for the most recent phase, where the focus shifts from just managing regulatory necessity to actively shaping the future of financial infrastructure.
Through bleeding-edge technology.
Exactly.
Which brings us to the fintech transformation phase, covering, say, 2019 to 2024.
Right, and this period is defined by global scaling, significant capital investment in core trading technology, and this massive pivot toward emerging tech like blockchain and AI.
We saw a key leadership change right at the start of this era.
We did. On January 2nd, 2019, Tim Gokey succeeded Rich Daley, the founding CEO.
Bringing new energy to the operational focus.
Right, but Daley remained as executive chairman, which was important. It ensured that historical knowledge and that strategy of consolidation was still there, right on the board.
And the financial scaling during this period is just rapid and dramatic.
It really is. Looking at their 2021 financials, they reported $4.993 billion in revenue.
With operating income of $678 million. And that's already a substantial operation, but the expansion since then has been even more aggressive.
And the acquisitions became even more strategic. They started focusing on global reach and these highly specialized financial segments.
Like in 2019, they acquired ClearStructure Financial Technology.
Right, specifically targeting portfolio management solutions for the notoriously complex private debt market.
They're just systematically moving into every high-margin corner of institutional finance.
They are, and their global ambitions became crystal clear with the European push. In 2020, they acquired Funds Library.
A firm specializing in fund document and data dissemination across Europe.
And they immediately combined it with an existing brand to form Broadridge Fund Communication Solutions. They were essentially replicating their U.S. communication control model across the EU investment landscape.
But the acquisition that truly signaled a change in their strategic DNA came in 2021.
Oh, the big one. The massive purchase of the Sweden-based Itiviti from Nordic Capital for $2.5 billion.
$2.5 billion.
Yeah. And Itiviti is not a communications company. It's a global capital markets trading technology provider. This was Broadridge buying deep, sophisticated expertise in trading infrastructure itself.
That's not a tuck-in acquisition. That is a fundamental, multi-billion-dollar bet on the future of trading.
A huge bet. And a $2.5 billion expenditure is massive. It required a shift in their immediate financial strategy.
I remember the CFO was very explicit afterward, focusing intently on debt reduction following that outlay.
It was a calculated risk to move from being an infrastructure provider to becoming a core trading engine.
And this investment leads us directly into the most interesting paradox of the whole Broadridge story.
Which is their aggressive embrace of distributed ledger technology blockchain.
A technology that is fundamentally designed to reduce or even eliminate the need for third-party intermediaries.
That's the heart of the matter. Broadridge began testing blockchain for proxy voting as early as 2018.
So they saw it coming.
They recognized that if the market was going to move towards decentralization, they needed to be the ones who controlled the new rails of that decentralized infrastructure.
And they rapidly scaled the technology from just testing to critical application.
Very quickly. By 2023, major global financial institutions, including UBS and Societe Generale, were actively using Broadridge's VMware blockchain distributed ledger software to facilitate repurchase agreements. Repos.
Okay, wait, let's pause on repos for a moment for our listener. Why are repos so fundamental to the capital markets?
Well, repos are just essential for liquidity and for the market to function. They're basically short-term loans, often overnight,
Right.
where securities like U.S. Treasuries are sold with an agreement to buy them back later at a slightly higher price. They allow banks and other financial institutions to manage their short-term cash needs and portfolio adjustments.
And the scale is huge.
Trillions of dollars of these agreements flow every year. They are the oil that keeps the banking system's engine running smoothly.
Understood. So Broadridge is inserting itself into the plumbing of daily essential banking liquidity using a technology blockchain that is supposed to make banks irrelevant.
And the scale is astonishing. By May 2023, Broadridge was facilitating $70 billion of blockchain repo trades per day.
$70 billion a day.
That figure is just staggering, and it really highlights their strategy. They are positioning themselves as the trusted node, the essential operational gateway, in what is conceptually a trustless system.
They're making the technology of disintermediation work for the ultimate intermediary.
They control the new ledger.
And they aren't stopping at the back office either. They're keenly adopting artificial intelligence for front-end market intelligence.
Right, which is evident in the launch of BondGPT in June 2023, and that was developed by LTX, which is the corporate bond trading platform owned by Broadridge.
And BondGPT is what
It's
exactly?
essentially a specialized large language model chatbot. It utilizes the power of OpenAI's GPT-4, but it's focused exclusively on the intricacies of the bond market.
So this shows a transition from being a processing engine, just taking in data and spitting out documents, to becoming a sophisticated market intelligence engine.
Precisely, providing high-value decision support for fixed-income traders.
And alongside these huge technological leaps, they continue to ensure their core offering remains attractive to the modern advisor and shareholder.
Their modernization efforts are heavily focused on wealth management and improving shareholder access.
Right, the wealth management platform, which was first adopted by UBS, it gained a significant second client in 2021.
RBC Wealth Management US.
Right, and the adoption by two major Tier 1 wealth management houses demonstrates that Broadridge's platform successfully standardized and streamlined these really complex advisory tasks.
It proved its success in this highly competitive vertical.
They also refined their communication tools, creating specific platforms like the Wealth and Focus Communications platform.
Which was first used by Cetera in 2022. And this shows a micro-focus on tailoring communications specifically for that high net worth client segment.
Ensuring regulatory compliance is met with an exceptional client experience.
And their 2024 offerings show a deep commitment to ensuring their infrastructure supports the next generation of investing. They released Sentry software for loan portfolio management, which shows breadth.
But critically, their core offerings now support the full modern spectrum of investment products. We're talking new mutual funds, UTFs, managed accounts, app-based trading, and zero commission trading.
So their technology works just as effectively for a $50 a month retail investor using a commission-free app as it does for a billion-dollar hedge fund.
They are truly future-proofing the plumbing to handle all scales and styles of investing.
And perhaps the most direct intervention in corporate governance to benefit the end investor is their enablement of pass-through voting.
Can you explain that?
It allows shareholders to proxy vote directly rather than having the vote cast as a block by an investment manager. They also developed a mobile app for proxy voting at annual meetings.
It's the ultimate strategic move.
It really is.
They control the pipes, they innovate the delivery mechanism, and they integrate the cutting-edge technology. They make the regulatory process compliant, efficient, and now accessible to the retail investor through a mobile app.
So it's no surprise that in 2024, Broadridge was ranked #3 on the prestigious IDC fintech rankings.
Solidifying their status as a global technology power, not just a back-office vendor.
And that comprehensive look at their transformation sets us up perfectly to summarize their total operational footprint and financial strength today in fiscal 2024.
Okay, let's put the current scale into some concrete numbers. In fiscal 2024, Broadridge reported some really impressive figures. It shows the accelerated success of their technological and acquisition strategy.
They reported total revenue of US $6.507 billion.
$6.5 billion. That's a significant leap from the figures we noted back in 2021.
It illustrates that sustained growth, fueled by their acquisitions and the platform scaling.
And the high profitability is critical for an infrastructure company like this. They reported operating income of US $1.303 billion.
Which is a powerful indicator of the stable, high-margin, recurring revenue that comes from controlling essential, regulated infrastructure.
And that resulted in a net income of US $0.698 billion.
Their balance sheet reflects this stability and defensibility. Total assets stand at US $8.242 billion.
With total equity reported at US $2.168 billion.
These are the markers of a robust, cash-generating, indispensable component of the S&P 500.
But the financial statements only capture the economic value, right? The operational scope is what really defines their influence.
Absolutely. Their global workforce has expanded significantly. It's reached 14,000 employees worldwide as of 2024. This is a complex global organization.
And we have to reiterate their market share reinforcement because this is the fundamental source of their power.
It is. Based on 2023 data, Broadridge confirmed they provided proxy services for around 80% of outstanding shares in the United States.
80%. That figure has remained remarkably consistent, reinforcing their status as a legally necessary component of corporate communication.
It's a huge swath of the market. They serve approximately 1,100 broker clients.
Which means virtually every major retail brokerage, every institutional trading house, and every wealth management firm is reliant on their pipes to meet regulatory mandates and communicate with their clients.
So, to summarize the core offerings of this $6.5 billion behemoth, you can categorize their influence into three essential pillars that span the entire financial life cycle.
Okay, pillar one.
First, they are the communications engine. They supply the mandatory financial documents, proxy statements, annual reports, and they run the virtual annual meetings.
Pillar two.
Second, they provide the essential compliant financial software and infrastructure for core corporate governance functions. They are the mandated link between the corporation, the intermediary, and the ultimate owner.
Without them, corporate democracy, as it's currently legislated, just stops.
It does. And third, they are now full-stack fintech innovators. They host major trading platforms like LTX and provide the complex software and technology platforms essential for both asset management and wealth management.
Embedding their tech directly into the highest value advisory relationships.
Exactly.
Finally, we should probably look at their leadership and governance structure, since they are essentially the gatekeeper of governance for everyone else.
It's a good point. Tim Gokey is the CEO, with Chris Perry serving as president, and the original founding CEO, Richard J. Daley, remains the chairman.
And the board.
Their board is an 11-member group, and it features heavy hitters from across the financial and regulatory sectors. You've got names like Leslie Brunn, Annette Nazareth, Pamela Carter, Eileen Murray.
So the inclusion of individuals with deep experience in finance and regulation, it signals that they take their role as an essential utility and custodian of corporate governance very seriously.
I think they have to.
What a remarkable journey, though. From a small administrative unit processing 300 trades a night in 1962 to a $6.5 billion revenue, 14,000 employee fintech powerhouse in 2024. They control the communication channel for 80% of U.S. corporate shares.
It's incredible. The story of Broadridge is the quintessential story of modern finance.
It is. Leveraging a regulatory necessity that required intermediary status created by the 1970s laws, and then using that essential position as a launchpad to transition into this indispensable, innovative fintech platform that spans the entire capital markets lifecycle.
And the key takeaway for you, the learner, is really understanding the hidden mechanics. You cannot analyze a proxy battle. You can't understand the complexities of modern wealth technology adoption or even appreciate the latency and security settlement without recognizing Broadridge's pervasive influence.
They're not just participating in the market.
No, they are the highly optimized, highly regulated pipes through which the market flows.
So we leave you with the central, provocative thought that really defines their future strategy. Broadridge's original monopoly was inadvertently created by that 1970s legislative mandate for immobilization, forcing the existence of the intermediary.
Right.
Now, the company is aggressively embracing distributed ledger technology blockchain, a tool famously touted for its ability to enable disintermediation and make central third parties unnecessary.
And that's the profound question for the next generation of finance. By controlling the adoption of distributed ledger technology for essential services like repo trading and shareholder voting, is Broadridge simply securing its dominant position for the next 50 years?
Becoming the central, trusted node that controls the new pipes of decentralized finance.
Or by introducing these decentralized peer-to-peer technologies into the bloodstream of Wall Street, is Broadridge inadvertently laying the groundwork for eventual challengers or disruptive changes that could threaten the regulatory moat it established half a century ago?
Something for you to consider as technology continues to reshape the core infrastructure of global capital.